Hey, what's up, guys? It's Jonathan here. The Jolts report, also known as the Job Openings and Labor Turnover Report, just came out for the month of October, and let me tell you, it was not good. The reason why this is so important is because the Federal Reserve wants to avoid a wage price spiral. By doing that, they need to lower the amount of jobs that are available because the labor market right now is so tight where people are getting significant pay raises by just leaving their current employer and going to another employer. So, to reduce people's PP, purchasing power, the Federal Reserve needs to shrink the amount of jobs that are available. Currently, we're sitting at a point where there's about 2 job openings for every one unemployed person. The Federal Reserve would like to see that number somewhere more around 1 job opening per person. So the market and the Fed has been paying very close attention to this report. So I decided let's make a quick summary video to discuss it and how it'll affect the Fed's decision making. So the headline number, which is the job opening number, we were expecting to have 9.75 million job openings. We actually got 10.7 million, which is 10% more than what we were expecting. And it was a month-to-month increase of about 450,000 job openings, I should say. So the largest increase in job openings was accommodation and food services, which jumped 215,000 job openings, which means that demand for the service is still very high, which is a not so good sign because that's kind of what the Federal Reserve wants to take away is people's purchasing power, especially for discretionary items like traveling and restaurants. But it does make some sense given the fact that we did have some leading indicators, especially some of the earnings we've got, like Delta and American Airlines, and just today, what we got from Airbnb. So I'm not too surprised about this one. One of the decreases I thought was pretty interesting was that we actually had a decrease of 83,000 jobs in the finance and industry sector, which makes sense inside a down market. Typically, the demand for those professionals go down because people either A, have less wealth, or B, are less interested in really investing. So it does make sense that we have some decreases there. When it comes to hiring, I should say hires fell to 6.1 million to about 4% for the month. The biggest decreases we saw were in durable goods manufacturing, which makes sense because durables, a great way to think about it is almost like home appliances or like cars, for example, which we know the car industry right now is on a rapid decline. Even though we may not see it necessarily in our day-to-day prices, like if you go and buy a car right now, you won't see that price difference. There's a lot of economists and a lot of people in the car business can clearly see that the market is on a downtrend. And then when it comes to home appliances, that makes sense because, I mean, real estate has taken an absolute shellac in the past, I want to say about 6 to 8 months. So no surprise there. And then we saw a pretty big decrease in state and local government education hiring, which makes sense because the peak hiring season is usually before the school year starts, so July and August. And now since we just got October readings, then it kind of makes sense that we are seeing a slowdown in that. But the good side of hiring is that we got the lowest reading that we've had in the past 18 months. So that is a good sign that we are starting to see hires decrease. But again, overall, the headline number was still high. So moving on to quits. This is probably the most important number for the Federal Reserve because quits is a good way to tell how people feel about the possibility of them being able to leave a job and to go take on another job for a higher pay. So this is probably one of the most important ones to pay attention to. That number was flat for the month at 4.1 million quits. And some of the biggest decreases we saw were in the construction sector, with about 56,000 less quits this month, which makes sense. Again, like I said, with real estate, we are starting to see a slowdown, and a lot of construction jobs do stem from real estate. So It does make sense that we are seeing a cool down there. Some other big categories we had some softness in was transportation, warehouse, and utilities, and also durable goods manufacturing, like we just talked about. So basically, some takeaways from this is that there was some good highlights, especially with the higher rate decreasing and us seeing some of the lowest hiring rates that we've seen since the beginning of 2021. But overall, this report isn't good. You know, we still saw that headline number significantly higher than what the market was expected. That basically guarantees that we're going to get a 75 basis point hike from the FOMC on Wednesday. But luckily, we're going to get October and November's readings before the next FOMC meeting in mid-December. And then also in that FOMC meeting, we're also expected to get a summary of economic projections, which is going to tell us where the Fed plans to go with their rate hikes in the future. So our hope is that possibly we'll get some more favorable numbers to the downside. And once we do, the Federal Reserve will soften the amount of rate hikes that they do, which will ultimately lead to a green stock market. But only time will tell. So thank you guys so much for watching. Like, share, and subscribe, and I'll see you in the next video.